go to Denise. Denise, could you introduce yourself and then could you just head right on into the talk?
Sure. Hi, my name is Denise Dunlap. I'm a managing partner and co-founder, along with Molly, with Sage Growth Capital. My background is in tech. I ran a company that was an IT services provider. We exited that company and then I got into angel investing. And I have been doing that since about 2008. I was a fund administrator for the Boise Angel Funds and have done a lot with the Angel Capital Association, a lot of the national efforts around angel investing. And in 2019, we formed Sage Growth Capital. So I am now focused on revenue-based funding, even though I am still an active angel investor and do a lot of things in that space. So, John, you want me to go ahead and just get started?
Yes, please.
Okay, all right, great. Well, thanks everybody for joining us today. Hopefully you can see my slides here. We're going to be talking about revenue-based funding, as Molly said, particular to Sage Growth Capital's model. This is a little bit of an agenda for what we'll talk about. We want to talk about Sage Growth, revenue-based finance in general, how it compares to other sources of capital, and then what our fund specifically is looking for in terms of criteria and what we've seen so far, and then we'll open that up to Q&A. So Sage Growth Capital is our management company. The partners are myself and Molly, who you've already met, and our partner Kevin Learned. Kevin is also an angel investor and has had a big role in the Angel Capital Association for many years. And he and I have together worked together on angel investing in Boise and elsewhere. We had been talking for a while about wanting to do something a little bit different. And part of the reason for that was Boise, Idaho was growing quickly, but we were not seeing the level of activity that we would expect to be able to maintain an angel group indefinitely. So the companies that we were investing in, we didn't have a lot of the unicorns that we're all looking for in angel investing. And we were having a hard time keeping our investors engaged over long term. So we had been looking for some different options or flavors of investing that we might be able to augment what we were doing. And that was when we met Molly as she moved to town. And she obviously had a great background, not only in finance, but in revenue-based financing through her experience with Lighter. And so the three of us decided to get together and start this fund, which we launched in 2019 and have been investing since that time. We are close to the end of our first fund and are getting ready to raise fund 2. So we'll talk a little bit more about that. But in general, so Sage Growth Capital is the management company. Sage Growth Capital Fund 1 is actually the fund that we're making investments out of. So I just talked about Kevin and Molly, or myself and Kevin, and Molly introduced herself. I won't go over that again, but that's a little bit about each of us. So what is revenue-based finance? Well, as you're aware or are learning, when entrepreneurs who need to fund their growth, they traditionally have sort of 3 options. I mean, there's more than that, but the main options available to entrepreneurs are bank lending, if they can get it. That requires collateral guarantees and significant cash flow in order to qualify. Anybody that's tried to get a bank loan will know exactly what I'm talking about here. Bootstrapping is what a lot of companies often, try to do, but that takes a long time, and your profit, it's dependent on you to have profits, right? So that can take much longer, and if you're trying to grow a company quickly, that's not probably your best approach. And then, of course, there's the option to sell stock. So hopefully you all are learning about that or already know about the options of being an angel investor and buying stock, and that's what we're looking for. But as you're probably aware, not all companies who wish to sell equity are really ready for that, or sometimes they don't have a model that is really attractive to equity investors. And so our goal here is to provide an additional source of capital for these companies that acts as a complement to bank and venture funding. So what is revenue-based finance? So RBF, as I will refer to it, is often described as something between a bank loan and venture capital. And the main differences between these funding types and RBF are that RBF investors generally don't require collateral or personal guarantees like a bank would. We generally don't take long-term ownership in the form of equity position in the companies in which we invest, obviously, as an angel investor would. And the RBF model doesn't require the company to have an exit strategy in order for us to get our money back. So that's probably one of the biggest differences there. So in general, what is it? So a revenue-based investment is one where the entrepreneur pays the investor a percentage of monthly revenue until the investor has been repaid their original investment plus a multiple. And we'll get into the details about that a little bit more in a second. But so as an example, an investor might invest $100,000 in exchange for the right to receive payments at 5% of monthly sales until a total of $250,000 have been paid. So this slide shows you a little bit how it works. So investors in RBF have to use some sort of an investment instrument. Pretty commonly, and in our case, it's a convertible note. So much like what we would do in angel investing, we use a convertible note that has some sort of trigger and terms around that note. So it is debt, but in our case, the note does not convert to equity unless the term has been met, but the payment hasn't been repaid. And so we'll talk about that too. So essentially, these are the components of that note. So the principal is the first one. Like all loans, principal is the amount that we invest. So in our case, at Sage will invest as little as $75,000 and as much as $400,000 in any one company. And that's largely based on the size of our fund and the need to diversify. The multiple is the amount times our principal to be repaid. So typically our multiples are between 2 and 3 times the investment. And the multiple that we will offer is dependent upon the company's risk profile and the expected time for them to complete repayment. Those two multiplied together equals the total note amount. In this case, you can see the principal times the multiple equals the note amount of $250,000. So the other pieces to this are the revenue rate. You can see here in the example, we've got 5%. So the revenue rate is the percentage of the cash receipts from sales that is paid each month until the note has been paid. So our typical revenue rate is between 3 and 8%. And when we're looking at cash sales or cash receipts, what we're looking at is the amount of sales that are revenue generating, money that's coming in that are revenue generating transactions. So that would be what was actually collected on accounts receivable, not what is outstanding on accounts receivable. So it's cash that gets put into the bank, basically. Cash receipts from direct sales or license fees from SaaS sales, something like that. We do not take a percentage of non-sales cash receipts. So if a company sells securities, for instance, they're selling stock, and they're showing revenue from that, we would not take a percentage of that. It's strictly from the cash receipts from sales activities. The payments are made up of a monthly payment. The monthly payment is made up of the revenue rate times the deposits from the sales activities that we just discussed each month. So that means that the payment amount fluctuates with sales each month. So when the sales go up, the payment goes up, and when sales go down, the payment also goes down. So this is a very attractive feature to entrepreneurs, obviously. If they're having a seasonality in their business, or they're having a rough month, and their payment will reflect that, and it'll go a little bit lower. And then if they're having a great month, then their payments will be a little higher. So what are some of the advantages of a revenue-based model? So this slide shows the advantages to both entrepreneurs and angel investors. So as I mentioned, from entrepreneurs, one of the biggest things that they like about this is that the payments are flexible and change depending on how their performance is doing. It's also less personally restrictive in terms than a bank loan would be. As I mentioned, we don't require personal guarantees or specific collateral for them to get the money. Probably most importantly is there's no dilution to themselves or the existing shareholders. So not all revenue-based lenders do this, but we do not take any kind of warrants or any kind of equity as part of our terms. Once they pay us off, we're gone. And what we're finding is this is a really good option for interim funding for companies. We're seeing entrepreneurs looking at RBF instead of a traditional convertible note that converts to equity at some point. And we're also seeing that this funding can result in a higher valuation, when the company does go out for equity later on. And then on the angel side, it's a really good source of non-dilutive bridge funding for portfolio companies. As I mentioned, a lot of companies we talk to are looking at RBF as an option for their bridge round rather than a traditional convertible note that converts to equity. And then from the investor standpoint, and I can tell you our fund investors really like this piece, RBF investors get their capital back much sooner without having to wait for an exit. So this next slide is, it's a chart that we put together that shows the most common funding sources for startups. You can see those sources on the left and how they rank compared to each other in various categories such as price, ease of access, and length of obligation across the top of the chart. In general, green means good or go, easy perhaps. Yellow means less so, and red means it's either difficult or it's not super favorable to the entrepreneur. And so what we're showing here is the second line. You can see revenue-based financing there in bold, shows how revenue-based financing stacks up against the other options. So I won't go through this whole chart, but in general, you can see a bank loan in terms of price and dilution is great, right? Because they're cheap if you can get them, and there's no dilution. There's no other investors coming in to dilute your share. We coded those as yellow because they're not as easy to get, they're not as accessible for every entrepreneur. And there is quite a bit of governance restriction around bank loans in terms of what you can and can't do while you're under that bank loan. And then the length of obligation we coded as green because typically those are pretty short-term relationships, and once the loan is paid off, it's gone. If you skip down to angels and VCs, obviously you're all familiar with that piece of it. The price is probably the big piece that people need to be aware of. The price of an angel or a venture capital investor, we as angel investors expect 10 to 20 times our money back, right? So ultimately that may be cheap money up front, but over the long term, it's a lot more expensive when we're expecting to get paid back. The ease of access is a little tougher. It's tough to raise money from angels and VCs. There's a lot of governance restrictions around that. And then obviously the length of obligation. Once you take angel investors or equity investors, then they're in it for the long haul, whether you want them there or not. So the idea there is just to kind of show you how revenue-based finance stacks up against the others. All right, and from here, I will turn it over to Molly to talk about the true cost of equity.
Yeah, actually, I'm watching the chat and there's some conversation a little bit around this in there about kind of the cap and what angel investors look for. One thing that we talk a lot to entrepreneurs about is the cost of taking dollars, especially angel and equity dollars, and what that does to you as a founder. But you could also think about it from the reverse side as an angel. When another angel round happens or when the next VC round happens, that significantly dilutes your ownership. So everybody gets diluted with that next round of capital that comes in. And this is kind of just, I'm sure you're all familiar with this, but this is easy math. So the dollars you raise plus the pre-money valuation equals the value of your company. The dollars you raise divided by the value of your company equals the dilution to the founder. So we have numbers on the next page just to kind of show you what that actually means. So if you raise $250,000 at a pre-money valuation of $750,000, the value of your company is $1 million, but the dilution to you was 25%. And that's really meaningful when we look at that over long term. So if you think of yourself and how many rounds your company is going to do, or as an angel, how many rounds that company is going to take on. If you go to the next slide, Denise, it is pretty meaningful. So each round continually dilutes you. And we just did a standard easy one here. This is 25% dilution per each round. And that doesn't take into account when you get into VCs and they've got their preferences that come out first before everybody else and go and flow through the waterfall. Just putting an RBF round in is a 33% increase if you just did, seed round, RBF round, and a Series A round in terms of the payout amount and the reduction to dilution to the company. So yes, 2x, 2.5x over and we didn't talk about length of time. Denise didn't talk about length of time, but that's over, 4 to 5 years. That's how long our traditional horizon we think is between 3 to 5 years for payoff. So if you paid us off really quickly, that would be a higher IRR. But if it takes you 5 years at 2.5x, we're probably only making, between maybe around 20% on that, depending on when your payments came in and how that flowed through. So, and that risk is equally shared. We actually have, and we'll go into this a little bit more, we have a grace period in ours, which a lot of investors don't do, but we think it's really important to give people the opportunity to put the money to work before they start having to pay us back on it. But in general, the dilution impact from taking rounds of equity is pretty steep to the entrepreneur or to the angel if you're in early in the seed round or the Series A. So you just need to think about that. And the RBF gives you this opportunity to put a round in there that doesn't create any dilution. Yes, you're going to pay more than you would pay a bank, but we're not taking personal guarantees. So that's kind of the trade-off you have to think about in that. And go to the next slide. So here's kind of goes to the questions that were in the chat. So on a revenue-based loan, our multiple is the 2.5 there, the green line going across. And then 35% IRR, which is kind of what a lot of angels are looking for, is the yellow line. And you can see that those cross at about the 2.25 mark if we take 2.5x. And then after that, our IRR is below that. The longer it takes you to repay us, obviously, the less our IRR is. And that's where angels can get that at the 10x mark at kind of the 6 or 7 years if that's where you exit. So if you think about the time value of money and kind of the impact to us, we really want to be where RBF lender is really well aligned with a company that wants to grow, because the faster that company grows, the faster they pay the RBF investor back, and therefore the IRR to that RBF investor is higher. So there's a really tight alignment around how the money gets used, what you're willing to invest in, not taking too much of the revenue on a monthly basis. One of the things that Denise, Kevin, and I spend a lot of time looking at when we're diligencing companies is, are we going to, what percentage of revenue can we take that doesn't harm the company so it can continue to grow and make strides forward? Because if they don't grow, then we're going to not get the IRRs that we're aiming for our overall fund. Go on the next slide. So we've talked a little bit in general about RBF. Sage's general criteria are that the company has to have $300,000 of annual revenue. We like to see stable gross margins of 40% or better. And that's really important, right? We're taking a percentage of revenue on a monthly basis. And if the gross margins are kind of all over the place, that can be really harmful to the business if we're taking a percentage of revenue and they don't have some stability in those margins. So that's something we pay a lot of attention to. We want to see a meaningful demonstration of how the funds will be used to accelerate growth. I just talked about how important growth is in that alignment. So we really look at that. And a manageable balance sheet. We don't want to see a big messy balance sheet that our money is going to go to pay down debt, because that really doesn't help grow the business, or pay down, aged AP or something like that. That's just not a good use of this capital. It is expensive capital. You really want to know that you're going to be able to grow with it. And we also like to see the support of angels or other angel groups. We don't take a governance role in the businesses. We are purely cash. We will help. We will, if somebody calls and asks questions, we will introduce them to whomever we know, let them use our LinkedIn as their Rolex, that type of stuff. But it is on the company to ask for that help, it's not part of our kind of daily calling you, seeing how you're doing. We do get monthly financials. We get only access to your bank account. That allows us to make sure there isn't fraud between the bank statements and the cash in the accounts, and it allows us to take the money out on a monthly basis. But we like to see that somebody else is kind of in there helping the company, supporting them from that kind of angel role, because it's not the role that we take within it. Go to the next slide, maybe. So things that we look for. So Sage, as I mentioned, is a little bit different than your traditional revenue-based financing. We don't just do technology. That's been a real focus of revenue-based financing, is SaaS technology. We will look at food businesses, services business with long-term contracts, and obviously SaaS businesses as well. What we won't look at are service businesses with large one-off projects. So if you have to continually win new, big, large contracts, that's not a really great fit for revenue-based financing, right? That you want to see consistency that you're going to be able to pay this investment down. And if you're constantly having to elephant hunt for that next big contract, and those contracts don't continue after you've won them, it's just a service for a period of time and then it's done, that's not a great fit. Also big ticket, durable consumer good products. But we do look at other consumer goods, more smaller ticket utilization. And we really like that companies understand the use of funds and the cost of capital. We think that's super important to go into a relationship with them. And go to the next slide. Our average deal terms are that we will invest up to a third of annual revenue, and between $100,000 and $400,000. The return cap is between 2 and 3x, as we mentioned. So we do what's called a 3-month grace period. So if we make an investment on January 1st, your first payment to us would be on the April financials on May 10th. So you really get 4 months because you're paying on the on your April cash on May 10th in order to have them utilize that cash and get started. We have monthly payments and the time frame is between 3 to 5 years. One of the beautiful things about revenue-based financing is that there are these 3 levers. You've got the return cap, the percentage on a monthly basis, and the time frame, and you can use those levers to match up to what the business wants to accomplish. So we can, if somebody says, I really need to have a very small percentage of revenue coming out on a monthly basis, that's what makes me the most nervous. You can have a longer period of time and a higher return cap and get to the same IRR that you would at a higher revenue rate with a lower return cap and a shorter period of time. So you've kind of got some levers you can play around with to kind of match the investment to the needs of the business. The key term, so our diligence process is fairly quick. We do an initial online application, we do a high-level call, we then present pricing. Because revenue-based financing is such a unique product and people aren't necessarily familiar with it, we like to do some initial pricing right off the bat so that we're all talking about the same thing and talking from the same page. We then do diligence calls, we issue a term sheet, we go to documentation. It takes us about 3 to 6 weeks to complete all of this. So it's fairly quick compared to your average angel investment period. And we think it's fairly, we get all the information we want, but we try to do it in not an overwhelming manner. And go to the next one. Kind of the key terms for us is we use a convertible note. It only converts on the due date, as Denise mentioned. And that's really the worst case scenario as far as we're concerned. We don't want to be equity holders in a business. And if we had to convert, that means that you didn't grow and we did as fast as we thought you were going to, or you thought you were going to. And so the business is probably not in the best position. And so it's kind of just gives us a seat at the table to have a conversation. And we've talked about the revenue rate and the multiple or the return cap. Our due date is what we say 12 months plus. So we kind of do the math to figure out how long we think it would take you to pay us back. And then we give you an additional 12-month grace period. And that's what we set as the maturity date for when the note converts. There is no stated interest rate, no guarantees, and no collateral on this, but it does require viewing access to your bank account. And the way that we get our payment is that on the 5th of the month after you've got all your cash, you tell us how much you think is from your customers by showing us your bank account and what you think is non-customer receipts. We agree on that, and on the 10th, we ACH it out. You can always repay a revenue-based investment at any time. You know what the return cap is and how much is due, so you can always just write that check and be done with it. Go to the next page. So we've done deals across multiple industries: technology, food, manufacturing, consumer products at this point in time. We've also looked at a bunch of different states. We thought we'd probably just focus on Idaho, but it's kind of spread out as we've gotten out there and talked to people. Angels in different areas have started sending us transactions that they want us to take a look at, specifically companies in their own portfolio that they would like a little bit more cash in there before they go and do another round because of the dilution impact we talked about earlier. The biggest problem that we see with companies is having a ton of debt or with unfavorable terms on them that's just not easily clean upable. And so just looking at balance sheets and understanding your own balance sheet if you're a company, or as an angel looking at your company's balance sheets and making sure that there isn't stuff in there that's going to be sticky. Because if it's sticky for us, it's also going to be sticky for a bank and probably for the next round of angel financing or VC financing or wherever you're going. And then I think some of the common issues, I just kind of talked about that. I think one of the ones that has jumped the most out of us, not just the over leveraged balance sheet, but friends and family investments that turn out not to be so friendly. People are like, oh, it's my best friend's uncle, and so it'll be fine. He's totally going to go along with changing something in it. And then they're like, nope, I want to be paid back. So that's just a really common issue we've seen. So when we talk to entrepreneurs, we like to bring that up. Be really clear about your documentation and know what you're getting into when you get those early investments, because they can kind of come back to bite you as you move forward. And then also founder motivation. You have to understand the impact of dilution for RBF to make sense to the founder. Otherwise, the equity looks like free money and they don't understand the impact of it till it's late down the road. We used at Lighter, we'd always say that our best customers were the ones who'd already started a fund and had a VC in it and exited, because they understood the total impact of having somebody else's money in their company and saw the dilution that they faced, that they didn't realize what what it was. Because not every company is going to be a unicorn, and you can sell your company for $10 million and that might be great, but it's not awesome if you've got all these press and other things in front of you. It can really impact your overall take-home dollars. We've got our contact information here, so you can find us online, on LinkedIn, the usual places. Our emails are all Molly or Denise or Kevin at sagegrowthcapital.com, so we're pretty easy to reach. And we'd love to connect with you. And if you have more questions, I see the chat has a lot of commentary going on, but I wasn't able to like respond to it while talking. So I'll let Denise tell me what happened.
Sure. So there's been a lot of chat. Some of it's been answered through your discussion, but there's a couple questions. Sorry, I'm just scrolling back through. One that I don't think really got answered. So John Seacrest asked, what do you think the total overhead of managing the 5 years of payback is as a percentage of the whole investment? Or how do we think about that?
So from a revenue-based financing fund perspective?
I think that's what he's asking, yeah.
I think that's a question for you, Denise, because you have to do our back office.
Well, this first fund is definitely an experiment. We are working on that. I don't know that our fund is probably a good example, because we have really done this on a shoestring. Largely, so I have another business called Loon Creek Capital, and we have really been utilizing most of the infrastructure from Loon Creek to make Sage work, just because we wanted to deliberately keep the cost down. We've sort of jokingly but seriously said that this is our experimental fund and our next fund will be the real one. So I really can't tell you what that is, because I think for our fund, our overhead has been abnormally low because of just what we've been doing. I will tell you, there's been some talk later on in the chat about other groups out there and who's doing this. There are a handful of funds out there that are doing revenue-based investment. There's a growing number of platforms and software-based groups that are trying to do this too. I will say that there's probably no standard cost structure established yet, but there's a lot of overhead behind it. As you're probably guessing, when the underwriting is a lot different than an angel fund process. And the administration of these investments after you've made them is absolutely a lot more work than making an angel investment that you put your money in, close the deal, and then you wait. As Molly referenced earlier, we're looking at their financials monthly. We're withdrawing a payment monthly. Our fund is then turning around and distributing those funds back to the investors quarterly. So just from a back office perspective, that's a lot more work than managing a traditional angel fund. So I'm sorry, I can't give you an exact number right now. Just know that it's quite a bit more. So
yeah, it's just logistically a lot more. I mean, just there's a lot more contact with the companies because of that monthly back and forth. So there's a little bit of higher burden on the company as well, because they have to provide you with monthly information, but a higher burden on the fund, because we have to actually figure that out. The other side of it is the IRS hasn't really figured out how they want to handle, this is really going into the weeds, so if I'm going too far, stop me. But the IRS hasn't figured out how to treat revenue-based financing. It's a new concept out there. So do you try to fully amortize the loan over the period of time without knowing when the loan's going to pay off and not knowing what the interest rate is? Or do you treat it all as principal up front or interest up front and then hope you get the principal on the back end? All of those things haven't been determined yet. So there's a lot more kind of accounting gray area going on in this this market, than your traditional angel convertible note that's already been really well established with, or, you know, a VC investment that's already been really well established within the industry. And everybody's doing something a little bit different. And then there are people who are taking warrants on top of that. And how does that get treated? I mean, there's just a lot of this is a really experimental area right now. I think Denise and I would say that we have done the most plain vanilla version that you could possibly imagine. We don't take any equity. It's a convertible note with no guarantees. So it's not really loan-like, and we are taking principal back first and then interest after we get all the principal. And that was our way of just being like, we don't want to mess with, you know, what could be happening here. And we told all our investors that you're getting interest and you just have to deal with that as part of this investment. So those are all things that I don't think people necessarily think about when they're setting these types of funds up, but there is kind of a whole logistical, there's also a lot of regulatory involved as well. So technically, if you're taking interest, now you have usury laws that could impact you. And each state has its own usury laws, and those are all different. And so you need to be aware of those as you go into it. So there's a lot more going on here than just, oh, well, I get paid a monthly contract and that's fine. And, you know, hopefully at the end, it doesn't convert into a convertible note. There's just a lot more kind of back office that needs to be worked out. And as the industry grows, I'm sure it will be more codified, but right now it just really isn't. And so everybody's kind of doing it on their own way on the fly and hoping for the best.
So your answers have stimulated a bunch more questions, but I'm going to jump back a little bit to one that didn't get answered. So one of the questions was, does growth in revenue translate to a stronger investment agreement, i.e. larger? I think what they're asking is,
what generally happens with RVF, and we've already done it within our own portfolio, is if you give a company money and then they do really well and grow quickly, you tend to be able to give them additional capital at a very similar revenue rate than you were at before because of the growth that they've experienced. And that allows you to increase your investment size and allows the company to pay the same percentage back without kind of impacting their overall business and continue to grow it. So, I mean, lots of companies take multiple rounds of it as they grow. And that is a great kind of way of continuing to leverage themselves into a better kind of next VC round or whatever that is that they're going for, or an exit. I mean, you can leverage yourself into a nice exit. I told Denise and Kevin, we're trying to LBO the angel community. We're going to be moving into that area because people have done it in PE really successfully, and they haven't really done it in the angel VC community successfully. And I think there's a play to be done there.
Yep, agreed. Okay, so a lot of the stuff that has been brought up in the chat has already been answered. There's a question about, is 2.5 multiple and 5% rate pretty standard? I think the answer to that is maybe. As Molly just said, there's not really any standards. Those that we've seen that are doing the most similar kind of RBF to what we're doing, I would say those are probably pretty standard for them. But as she said, there's a lot of people experimenting with all kinds of stuff. One of the things that will be interesting to me to see how it turns out is there's definitely a number of groups experimenting with how to do revenue-based finance for pre-revenue companies. So I'm not sure at that point you can really call it revenue-based finance if there's no revenue, but there has been some experimentation with that, and it'll be interesting to see how that turns out. You know, we won't know yet for a while, but an interesting question.
There was a question about subordination. So in our structure, we are subordinate to all the other debt that's on your business. So if you had a bank loan or CDFI or anybody else, then our convertible note would sit in the same part of the cap table that the traditional convertible note would, and therefore it would be subordinated. There are lots of RBF funds that take UCC filings and therefore do not subordinate. They want the first position. So like Lighter takes a first position, except for to a couple of banks that they have standard subordination agreements with. But generally they're filing UCCs. So UCC is the Uniform Code of Conduct. I think it's how you file a lien on a business. So that it just depends. Again, this is a really new area where people are experimenting with lots of different things, but in our structure, we've decided that we will sit with convertible notes and be subordinated to the traditional people.
So there's a question about, do we see angels and VCs like to see RBF in the mix? And are there any downsides for other investors? I'll let Molly talk to this too, but so far we've seen that investors, angels at least, understand RBF and can appreciate it. As I said earlier, we're seeing companies using this as a non-dilutive bridge round. And if you're in that early seed stage round, yes, you like RBF because it goes away once it's repaid. And we had a company, one of the companies in our portfolio that was raising, and I don't remember the numbers offhand, but like at $1 million valuation when we started working with him. And then a year later, he's doing, after taking our money and putting it to work, he is doing a funding round at a $20 million valuation. So his early stage investors are really liking that, especially because they all had a convertible note with the discount on it, a cap on it. Molly, do you want to comment on your experience with VCs?
Yeah. So when RBF started, VCs didn't like it, and now they love it. They're all starting their own funds. They figured out that this was actually a great way to get their companies to grow without, diluting them further. So it's changed. The market has changed on that. And I'd say that they're very supportive and they're looking for people to come in, especially for a company that has kind of plateaued. So it's grown and then it's plateaued a little bit and they think they've got the next product market fit or whatever it is to get to the next state level. They do actually use a fair amount of RBF to accomplish that versus further diluting their own founders in the process. So I think VCs have become much more open to that concept over time, and angels seem to have been hearing about it a lot more. And it's more of an education. I mean, this is a new market, so everything is an education in it. But the more educated they are, the more open they are to it as something on their cap table. And a lot of times when a VC is coming in, there's a ton of money coming in, and they may just decide to pay off the RBF just because it's because of the extra work that it creates on that monthly cadence. But most of the time at Lighter, we just saw them keep it rolling because it was just added capital within the business. So why would you pay that out? Mm-hmm. Somebody asked, when you hit the 2.5 multiple, is that a payoff? Yes. So at whatever point you hit the cap that is set for the company, that point in time, the convertible note goes away. It just leaves your balance sheet. You're done. So you've been amortizing that down as you've been paying it off on your balance sheet, and then it just disappears. It's all done and there's no more contract, nothing in place. We don't do UCC filings because we think that eventually we can convince the IRS that this is a capital gains, right? We are taking a risk when we make this investment in the company. We don't know when we're going to get paid. We don't know how we're going to get paid, very similar to an angel investment. So we don't want to treat it like a loan. We want it to eventually be treated more along the lines of your traditional cap gains investment. And in order to do that, we think that taking a UCC filing probably doesn't make sense. Plus, it's just like extra work and doesn't really do you a whole lot of good. If you think about the companies we're investing in, how much real assets do they have that we're going to go collect on if the company goes into bankruptcy? Like, not that much. So I'm going to go get some ice cream and bring it home and put it in my freezer. I mean, that's the extent of where we are. So that just, it's not a valuable asset in our opinion in terms of the process.
So there was a question further back about the expectation that our experimental fund will meet our definition or parameters of success. So we like to talk about when we started this that we had, you know, three sort of main premise or hypotheses when we started this. The first one is, you know, that we could raise the money from angel investors, not institutions, not, you know, other places. And we proved that right off the bat. We reached first close in a week, and we had our fund oversubscribed within 5 months and closed out. So I can tell you from my experience of raising angel funds of similar size, that time frame is much more like 6 months to first close and 2 years to raising, you know, to closing, and, you know, typically not oversubscribed. So our investors understood that, and so really we felt like we've achieved success in the first hypothesis, which is, can we raise the money? The second one was, can we invest it? Can we find companies to invest this money in? That has been much more of a challenge. And as Molly mentioned earlier, you know, we originally thought we would start with Idaho as our geographic focus area, and then we quickly expanded that to the Pacific Northwest, and then we ended up expanding it to anybody who comes as a referral to us from an angel group that we know. And the reason for that was we found that while investors understand this model and like the value, companies did not. Not that they didn't like the value, they just didn't understand it. And what's more, their advisors, their you know, accountants, their attorneys, they didn't understand it either, and they didn't, you know, so it was viewed somewhat with suspicion. And so we spent a lot more time educating and just kind of talking about the model and helping people understand what the value proposition is to them than we had really expected. So our deal flow has been a lot more lumpy than we had expected, and that's why we decided to expand our geographic area of focus. And then the third question is, can we do this and make money at it? Well, we don't know yet. You know, we're 2 years into this. We're down to our last probably 2 deals, and then we're out of money. So far, so good. As I said, we've been running this on a shoestring, so that's maybe not a totally fair judge of whether we can make money. But I will tell you, as far as the companies that are in the repayment phase and paying us back, they're all still in business. They're all still paying us back pretty much as we expected. So so far, so good. We feel like the fund has been enough of a success that, as I mentioned earlier, we're planning to raise a second fund. So obviously we will be tweaking a few things about our second fund, but in general, I think we're all pretty pleased with how this has turned out, especially because our source of funds has been individual angel investors, not banks. You know, we're not leveraging a line of credit. We haven't raised money from grants or other sources where a lot of other funds have done that. So I don't know, Molly, do you want to add anything to that?
I think the fact that we think we're going to raise a second fund kind of speaks to whether we think we've hit our success metrics, which I think we have. I mean, the deal flow part has certainly been harder, but we have decided to focus on angels. And I think that has really improved our deal flow. Once we made that decision that angels were the right group to start talking to about deal flow, because they see the type of companies that we want to see, but they also understand this product a lot better than your traditional, you know, accountant who's doing, you know, who's the controller for 4 other manufacturing companies and isn't used to seeing any of that on their balance sheet. It was definitely we've seen a lot more improvement in deal flow and in the quality of the companies that we've seen from them. So I think that has really helped out a lot.
Yeah, for sure. So John's asking, what was the size of the fund, the investment period, and when do we expect the last payment? Size of the fund was 2.1 million. The investment period, so we started investing in October of 2019. Is that right, Molly?
Yep.
And we are still investing. So as I said, we've got enough money to probably do, you know, depending on the size of the deal, maybe 1 to 2 deals left. And then the last payment from the last company, well, I don't know yet. When we make the last investment, we'll let you know. But the time period, repayment periods on our deals are typically, 48 months?
48 months.
Yeah.
So it depends on if that last deal is a 60-monther, then 60 months from that day would be kind of the end of it. But we tend to do 48 months. Some of them are 3-year deals. It just depends on the company and what they were looking for.
Mm-hmm. Yeah. And then the question also is, how have we paid for the staffing up front for the work? ahead of payments from the company as well. You're looking at it. Molly and Kevin and I put money in and have definitely funded the operations for the group. We do get paid in a couple of ways. We take a percentage of what is it? A distribution fee. So whenever we distribute funds to our investors, we do take a distribution fee, and then we also have an origination fee that we charge the companies when we do the deals, and that is split between us and the fund to help pay off the fund's expenses. We will be doing that a little differently with our new fund. We're going with a more traditional management and carry model for the general partners. Molly, do you want to comment on how accurate have our company's estimates been so far?
I'm pretty pleased with my accuracy in predicting how much they would pay us back. I mean, we're a little bit off, but not outside the realm of rationality, especially because we're very on track for the first couple 6 months. That always seems to be pretty close. And then once you get to 2 years out, I mean, we're almost at 2 years on one of our deals and we're still pretty close. So feel pretty good about those estimates, but COVID was interesting, certainly had impacts on our companies and kind of the flows that they come in. So I kind of look at it from a cumulative perspective, not a month to month, because if I looked at it every single month, I'd be like pulling my hair out. I have to look at the cumulative, how close are we cumulatively to where I thought we were going to be? And that hasn't been bad. Do we have many payoff early? We do. We're in the middle of negotiating with a company who got acquired super early. So we're not going to do the full cap on that because that just seems rude. So we've had one already has happened to us where they've had a really early exit sooner than we expected.
So there's a question about, have we placed any special emphasis on funding diverse founders? So our fund has not. Initially, when we were looking at this, a lot of the groups that are out there that are using revenue-based finance or some sort of alternative financing model are really focused on diversity or women or something. A lot of them are looking for social impact or climate change, whatever. We did not choose to do that, largely because we felt like, based out of Boise, Idaho, we probably wouldn't have that luxury in terms of deal flow. And it turns out that we were right. What's interesting about our portfolio is it has ended up being rather diverse. It was not intentional on our part, but it just kind of worked out that way. And of course, we pay attention to those things when they come through. So, our goal here is really to prove that this funding mechanism is a legitimate asset class, and it's not limited to one use or another, such as funding underrepresented founders. I know that's a lot of the reason why people that start these funds are looking at that, but our goal really was to provide just, to focus on the fact that you can invest in this and make money at it. And so far, so good. So.
I mean, Denise and I represent a lot of diversity. And
we do.
We just have one old white man in our company. The rest of us are all women, so.
I think we've answered all the questions. If I missed one, I apologize. Feel free to speak up.
If I could, I don't know, is it okay if I speak? Can you hear me?
Yeah.
And well, first of all, thank you for your presentation. And you just responded to a question I had, so thank you for that. This is Diane. I do have a question for a gentleman earlier. When we first started, is this the right time for me to interject or ask a separate question for someone else, or should I wait?
John's giving you the thumbs up. I think go for it.
I didn't know. I felt like we were at the end, but if I should wait, I can certainly do so. Just typing it in, I thought might be a little convoluted. So
we have another 47 minutes in our allotted time period.
Okay, then I'll wait.
No, the other way around. Go.
Oh. Okay, and it tags off of what you ladies both just Molly and Denise referred to. There was a gentleman early on, and I don't recall his name, and he had mentioned that he was looking to expand. I'm not sure if it was his company's offerings or what element of it, but he mentioned that he was about to be reaching out to he said females, so a female population. And what he said was he was very excited about the opportunity to reach out to females. And that's fine with me. I don't care if it's females or women. But what I'm interested in hearing from this co-founder is, what about reaching out to the female population excites him, since he used those terms? So I guess that's a diversity question.
I don't remember the comment, so.
I think that was Wes. Is Wes still on?
Oh,
I'm on, but I think from this perspective, it's more about getting representation and diversity in both the investor pools and in companies. You know, the idea behind that is really more voices at the table that are different than you. Is you're going to have better investment decisions. You're going to have not everybody that's necessarily agreeing with you, and you're through that you're going to get better decisions. So that's kind of the thesis behind that. Does that help answer your question, or what does that mean to you?
I'm really here listening and learning, and it was just when you mentioned that earlier. By the way, I think it's fabulous. I was just, you know, it kind of piqued my curiosity in terms of the term excitement. So thank you for explaining that.
Absolutely.
are there other thoughts or questions that people have?
I think being
No one.
part of SAC for the past years, I've learned from John that women founders tend to be a little bit more successful in their entrepreneurial pathways too. So from the investor standpoint or angel investor standpoint, yeah, I mean, we look at women founders and go, okay, let's see what they got, and with that understanding that whatever the metrics are, they tend to be more successful. John, you can chime in on that with whatever study that you mentioned before.
Yeah, so it's certainly true that the data shows that having women on the founding team tends to outperform by 25 to 30% over time. But our goal is, as a Seattle Angel Conference, is to create more people that are writing checks and create stronger companies that are taking checks. So getting people of diverse populations to understand even just the vocabulary helps expand that broader into the community. Are there, Dante, you had a question that you started?
Yeah, so so thank you for the presentation. That, you know, 300K annual revenue number as kind of like the baseline. I mean, I could understand why the deal flow would be lumpy, right? Because that's kind of a high bar for, you know, early stage startups. But if you're a startup that's generating some revenue, that's not over that bar, and you're kind of managing to some sort of threshold event where you think you would be over that bar after this event, what would you guys say? Does it make sense for a company in that situation to kind of go the angel route because it's just not, you know, it's still pretty speculative, right? Or is there any sort of play for revenue growth, you know, funding in that scenario?
Depending on what you're looking for, CDFIs, so your like community development funds, are great for companies that are sub 300,000 in revenue. I just think that they're well set up to handle that. They've got all sorts of mentoringships, all those tools. I think you're going to have a hard time even in the angel community, depending on, you know, managing to a threshold event. You can come to most revenue-based financiers and say, here's the event, and they'll take a look at it and tell you if that's something that they're willing to take a risk on or not. But, you know, the reason that it's kind of 300,000 is that we want to be able to put meaningful capital in, which is about $100,000 at a third of your revenue. Otherwise, the 50K doesn't really get people very far. I mean, it might get you a little ways, but it tends to not be enough to really move the needle. And so that's why we kind of chose 300,000 as our starting point. That's about 15K per month in revenue. which, you know, some months you're going to have 5 and some months you're going to have 20, and that averages out okay. But it's kind of like just having a point in time where you can say yes. A lot of times you can look at like a runway and say, okay, the last 6 months I've hit that hurdle. Now I didn't make it for 12 months, but I'm obviously on the way towards it. And that's something that people will look at a lot. But yeah, I'd say I would definitely look at CDFIs because they're great for like really early stage companies, and they're not going to dilute you the same way taking angels is. Now, you can also go take angel money or friends and family. They're great at that stage too.
Got it. Thank you.
So we just did in the food ecosystem calls that I'm running, we just did a talk on Wednesday around financing farm and food industry things using angels and CDFIs and the different things that are sort of in the middle. And I have a recording of that if you're interested in that particular kind of thing, we can talk about. But if you think about where Molly is talking about 300K annual recurring revenue, that suggests that you're still in the very early stages. You're not taking a 750K angel round, you're taking the 50K or the 100K individual angel coming in, or really you're in the friends and family round where you're getting 5K from some of your friends to get up to the 50K so that you can get the ball rolling. So that 50K gets you enough revenue so you can get to the 100K investment. And there's a ratio between your income and your investment that is worth paying attention to here. Are there other questions that people have?
Sure. I had a question on.
Go ahead.
Question on valuation, I guess maybe more for Molly. So as an angel, one of my concerns is valuations keep going up and up, and it's more difficult to finding attractive investments. But kind of your experience with Lighter as valuations keep going up, are you seeing that angels, they have these more attractive, it's kind of cheaper in terms of dilution to raise money from VCs? So are they using that negotiating power with you to say, well, we're not going to give you 3x, we're going to give you just 2x instead?
Yeah, I mean, valuations have gone up on the coast, but not in the center of the country. So there's kind of that side of it too. And it hasn't crept down far enough into these smaller companies to really impact them that way. So you're not, I mean, if a VC is going to invest in a smaller company, it's because the idea they think is $1 billion, $20 billion idea there. And so there's no way RBF is going to compete with that at all. Like they're just going to put so much money behind it. So that's not as big a problem. What Lighter's seeing in the SaaS world is that the banks have started moving in. So banks are really interested in MRR lines these days, and they will actually do them. If you have more than $1 million in revenue, a bank will give you an MRR line. And so that has created a lot more competition for Lighter because those are a lot cheaper than what Lighter can offer because a bank has cheaper cash, right? So that's the competition there. I think somebody asked, are there other RBF companies to look at? So there are a lot more starting out. If you're in the tech space, you have a lot more RBF options, right? There's Lighter, there's SaaS Capital, there's Clearbank, but Clearbank's in the e-commerce side, and they're a little sketchy, so I'd probably stay away from them. But just from like seeing their docs, I think they've got some stuff in their docs that I wouldn't be super fond of. But there are a lot more people kind of competing in that space, and so you can have a more competitive and maybe get more cash or get them to give you a larger times your ARR or MRR based on having more people out there if you're in the tech space. If you're outside of the tech space, you don't have a lot of RBF options because I think where Sage is playing, we've done tech, but we also have done food and we've done manufacturing. And that is definitely, we're pushing the limits on what people have tried to do in RBF by doing that. But we think there's lots of recurring revenue that happens in the food industry. I mean, the ice cream keeps going back on the shelf. I keep using that example because we have a great ice cream company, but I mean, those things get consumed and get used. And so it's something that you can look at in a recurring nature, in a recurring way. So, and somebody asked about PayPal and Stripe are very expensive. So that is a 3-month payback where you were paying daily or weekly or not, and definitely not monthly. So when you think about like time value of money and cost of money, I actually have 2 blog posts going up sometime in the next couple of weeks about like understanding the time value of money. When you pay something back daily, that IRR is outrageous. And it's, especially if you're doing it over a short period of time, like 3 months or less than 180 days. That's like 50 to 75% IRR. That's the like 50 to 75% interest to you as a company. And those are great short-term things to do, but they are not a long-term solution to your problem. And you should not be using them like a long-term solution to your problem, because I'm going to use a really bad example. It is like heroin. It is very hard to get off of once you start taking them, because you get cooked and you now are only getting 80% back on that $100 that you were selling. You're only getting that 80% or even less. It could be 50% depending on the interest rate. And so it's hard to make up that difference over time. If you do it one time just to fill a gap, fine, but don't continually do that, because you will have a really hard time getting out of that cycle.
Going back to the question about, you know, what should you look out for other RVF companies? As Molly said, Sage is one of the few that is really investing outside of SaaS or tech. One thing I would say though is if you do find a group that you're looking at, just go to their website and find out what their investment thesis is. So many companies don't bother to do that. We get applications all the time for stuff that are not even vaguely close to what it is that we do. And I know that that's true of other people. I know that's true of angels too. I've seen that, you know, we all get frustrated when companies don't bother to go to our website and find out where we want to invest and bother to read the criteria. But you know, everybody that's in RVF has that information out there. Just go familiarize yourself with it before you apply, because that's not making a very good impression if you come to a company and you have no idea what they do or how their model works. And that has happened to us a couple times. And then the other thing I would like to say back on the subject of valuations, that is one of the fun things about revenue-based finance is we don't have a conversation about valuations. We don't care. And as a seasoned angel investor, I love saying that to founders. I don't care what your valuation is. I don't care what it's going to be. You know, show me your revenue. That's what's really interesting to us. And, you know, like an angel investor, of course, we're looking at the total size of the market and the potential for growth and all of those things. But valuation really is not a conversation that we have, which is fun and liberating for me. I think that's all the questions I've seen so far.
So Mindy, as a CFO type person, that is the one that the company's going to go to when they come and tell you they're going to do a revenue loan or a revenue-based financing deal, what do you tell them?
Well, I mean, there are lots of positive aspects as they have communicated. And if you're really, really certain that you're going to grow, it seems like a great non-dilutive way to get the money. So I think it's pretty much like the kid on Christmas Eve. How much do you believe? So if you believe, let's go for it. Let's make Santa the cookies and let's do the loan.
So I think that Denise said something really important earlier about managing the variance in the revenue and the margins, right?
Right.
So by the time you have an understanding of what your bounds and variance in your revenue is, you have your business engine under some level of control. And so
right.
They're basically filtering out the people that don't have their financial discipline under control. And so there's a whole lesson there for startups about how to have financial discipline and make that go. But their filtering model is based on operational control of your business. And so then the second question would be, they're spending a lot of time trying to convince CPAs and lawyers that this is actually useful. As a CPA, how would you learn about this stuff in a way that you would decide that it was okay? You know, some random CPA in Indiana, how are they going to know that this business should consider a revenue-based financing? What's the communication channels?
Well, most of the time, what the CPAs I run into, they just don't understand this type of thing. And I haven't had a whole lot of it in my world. This is not a big East Coast thing, and I'm on the East Coast. This is very much a West Coast thing. And I think one of the questions that a traditional tax CPA is going to have, how's this going to impact the interest expense on the tax return? How does that work, Molly?
Yeah, we're pretty clear about that. So all your original payments go to principal until principal is paid down, and then it becomes interest for the remainder. So if you look at the 2.5x example, the first one is your principal, and then the 1.5 is your interest, but that doesn't kick in until after you've paid your principal. And actually that works out pretty well for the companies because they don't get the write-off on the principal, and they're probably not making that much money in the early stages. But then once they start to make money, they do get that interest income deduction later on as that's going through.
Okay.
So hopefully they're more profitable.
And that translates to taxes too. I mean, I know you described that earlier in terms of the way you structure the
it translates to our investors' taxes, right? They end up paying taxes on that interest income. We recommend doing this out of your IRA or your 401k if you want to avoid the taxes, but we're not accountants, so we, just say that to people as like an option for them to think about.
Mm-hmm.
Out of your Roth IRA.
Out of your Roth, yes, your Roth IRA.
So
investors just get a 1099 div.
They get a K1, but it's on the K1. There's interest listed.
Okay.
So can you compare a little bit revenue loan, which is what you're doing, with structuring this as a revenue redemption of equity, so that we can implement, the thought running through my mind is to implement a 5-year grace period, take the equity, and then be at use rule 1202 to get 0% capital gains tax. So there's basically two sets of knobs. Instead of taking a 3-month grace period, do a 5-year grace period and take it as stock, and then do it straight that way.
Yeah, sure. As long as the company has the positive equity on their balance sheet. I mean, so in 5 years, if the company's still around and has positive equity, then you're fine. But if right now, most of the companies we look at, their equity accounts are not large enough to take that redemption against it if we were to start that tomorrow, right? It would end up going into negative territory. And should that happen,
the redemption would still be a 4% or 5% of revenue mechanism.
Yeah, if you were to take an equity redemption and the company then went into negative equity as part of that redemption to you, right? Because that's how you were doing it. And then the company were to go into bankruptcy, you would be up a creek without a paddle, probably. You'd have to provide the differential back, because the company should not have provided you with that equity redemption when they went negative on their balance sheet. And
I'm very confused about what you're saying. So I don't think,
as long as the company does well, you're fine. If the company doesn't do well, you could be in big trouble, I guess is the way to think about it. So that's the risk you're taking.
so if the company doesn't do well for you, you don't get paid.
Yes.
And revenue redemption of equity, if the company doesn't do well, you don't get paid.
Well, yeah, you don't get paid, but if you took it, if they were doing, so for us, if the company doesn't do well 3 years in, so say we've gotten paid for 3 years and then suddenly something happens, they had one major customer and they blew up and they're no longer a successful business. They can't pay us any longer. All right, well, the 3 years that we've received is safe. There's no, that was all fine. But for you, if you took the equity redemption and it caused their equity accounts to go negative, then the company loses a customer and is out of business and goes into bankruptcy. Creditors could look to you to try to return their money. It's unlikely that they could look to us, but they could look to you because of that equity redemption. Now, I mean, it's a long shot case. Most people don't file bankruptcy. Most creditors aren't going to do that, but it's a risk that you have to be aware of and factor into your analysis.
Okay. Okay. Caitlin, any questions?
Oh, I have lots of questions, but I had to drop out and come back in. So I might be asking something you've already talked about.
Oh, that's all right. Go for it.
Okay. I've been trying to work on versions of this model that would allow for me to be able to invest pre-revenue. I know that's not really the way you approach it because of the risk involved, but is risk the only reason, or are there other reasons why this kind of model wouldn't work if the repayment starting in year 3, but revenue is only starting in year 2 or something like that?
No, I think it's just highly, I mean, your cap better be a lot higher to make up for the defaults you're going to experience in your overall portfolio. And then you got to find a lot of companies that want to take that cap. One of the things we saw early on at Lighter, they'd done a bunch of experimentation before I showed up, and I did a cleanup of their investments. And the companies with the largest caps, like they'd done some 10x caps and some 5x caps, those companies were really unhappy because they didn't see a light at the end of their tunnel to get out of that investment. And yes, Lighter had taken a huge risk on them. And some of them, I think, were like really early, we did not have a base hurdle for how much revenue you had to have when they made these investments. But those companies just didn't see a way to ever pay this off. They were making these monthly payments and just, it was like $100 a month, and there was no way they were going to ever hit that 10x cap. And so unless you really grew, it was demoralizing on some level. So you just have to think about like the mentality from the company's perspective. The other thing we saw a lot is if you take a really high percentage of revenue on a monthly basis, that's also demoralizing and can lead to people trying to commit fraud. I mean, like taxes. The more that's coming out, the more you're incentivized to not show as much
and make sure you don't have any showing. Yeah.
And so it's like that's a similar situation can arise depending on how you're handling that percentage of revenue on a monthly basis.
Okay. Yeah, that makes sense. Part of what we're looking at is companies who are not the typical unicorn type exit, but still have a high profit margin on their unit economics. And so looking at, okay, because I'm mostly working with companies that have at least some physical product component, often the capital that they need the most is actually pre-revenue. And so trying to figure out if there's some way to say, okay, once you hit certain milestones or you're at a certain place in your development, or is there some way that we can kind of help bridge that gap to revenue with something that maybe can handle, I've been modeling it out, and kind of the 8 to 10% is high for what this model typically uses. But if you've got an 80 to 90% gross margin on your disposables, then it seems like it could work. But every group I've talked to has been like, no, don't start that pre-revenue. And so it's just helpful to hear your take. Could you also
higher risk? What's your appetite?
Okay. I've also seen.
You muted yourself.
John, did you mean to mute me? Do you want me to stop talking? Okay. Second question is, you do this on a monthly basis. So did you already explain kind of how frequently, in terms of people getting their books and getting that, I know some people who do it on an annual basis or a quarterly basis, or kind of how has that been on the founder trying to make it happen on a monthly basis?
We do it monthly on your bank statement, so it makes it a lot easier, so you don't have to close your books. And then we get your financials and can compare them to your books. And obviously your bank statement and your books, if you're doing accrual accounting, are not going to match, but they're going to be close enough over a period of time that we can make sure that there's not another bank account that we're not seeing with cash coming into it. But it just makes it easier on everybody, right? Your bank statement is pretty clean. It shows you what your customers paid. And then you can also say, hey, no, that's a refund from the IRS, or that's something else. And, it's pretty easy to track what that is and why that would be there. And it just makes it easier on everybody to do it that way.
Are there some companies that you work with, not just on the accounting, but like helping their business, where as the space is becoming more competitive, I'm very experienced, Angel, your experience at Lighter Capital, that will really kind of help guide you through this process?
Kevin isn't here, so I can say this. We call him the sage of Sage Capital because he is older and wiser and done a ton of angel and owned a couple businesses and is just super smart. So yes, we do that, but we don't advertise it. We're very clear that we're cash for people on their balance sheet. But if you need help, you can obviously always call us and we'll help. We'll make the introductions. We'll look at our, I'm happy to have somebody look at my LinkedIn page and say, can I meet these 5 people and make those introductions for them? But that's not kind of our day-to-day processing. But Kevin is great. He holds office hours. He talks to people. He's very kind of, he is the sage. He's like the nice, gentlemanly person. Whereas I'm not. So it doesn't
Are we
work.
talking about the same Kevin?
Much nicer than I am. So I'm like the diligence grinder and he's like much more like the nice person. So we all have our assigned roles within the company. It works out very nicely.
Thanks for a good team.
Yeah, it's a perfect team. It's great.
I will say that a lot of the groups that are out there that are doing revenue-based finance are affiliated somehow with an incubator or an accelerator program. And a lot of them sort of were born from that incubator or accelerator program as a way to provide funding to their members. And so I've also seen that a lot of them, that's how they're funding some of their operations, is through the revenue that they're generating through their incubators or accelerators. And so when we have met with those groups, we did talk about that initially, if we wanted to try and do that as a way to help, with deal flow and all those kinds of things. And then we decided, we need to just focus on the money side. Molly, Kevin, and I all have other things that we work on. And so we felt like, spending time really coaching entrepreneurs was not probably the best use of our time, but we do like to partner with groups that do. So we've really reached out to a lot of different incubators or accelerator type programs to educate them about our model and also to keep those relationships open so that they can potentially feed us deals when they see them. So that is going to be a big part of our strategy for our second fund, is to really have those kinds of partnership relationships rather than trying to offer that service ourselves.
What percentage of companies that work with you in an RBF kind of context also then take on traditional VC, or what percentage is it really kind of a different type of company?
So all of our companies have had some type of angel investment in them alongside the RBF. Lighter would tell you that it is a third of their companies go on to VC. A third are family founder that are never going to do VC, angel, etc. And a third are kind of angel or, maybe hopeful for being VC, but probably won't make it there. So they would say that that's kind of their portfolio mix. Like they've got a third that's got angel in there, but they're not going to make it to VC. They're not growing fast enough. But it does, RBF works well. It can work well if going into it, you all know that this is not going to be an angel long-term play. This is going to be a family run, home business. And this is just another form of financing for them to do a non-dilutive way. If you all know that going in, and so you can structure the payment structure to not have the kind of hockey stick growth that a VC would expect, that you would expect if you were going to go the VC route, you can still do that. It just is probably a higher percentage of revenue over a shorter period of time in order to reduce your risk. So it's really about risk appetite and how you want to structure it. But ours have all had angels already in them. They're all looking to grow significantly. And that's why they took the RBF money.
I would add to that, and Molly touched on this earlier when we were talking about founder motivations. What we have found that is if a company does not ever intend or is truly not a fit for equity investors of any sort, the value proposition of RBF does not hold up for them. And so, unless they are looking at us in comparison to a traditional equity return, they have a hard time seeing, it seems like really expensive money, which it is. But so that's been a pretty big learning for us, is if the only other thing that they would ever reasonably qualify for would be you know, a bank or CDFI funding, it's really hard for them to justify to their accountants that they should go a route, unless they're really, really desperate, in which case we probably aren't really interested in either.
So one of the things founders need to think about is most founders that take a seed round do not succeed in getting their Series A round, and they probably should have a plan B. And revenue-based financing is one of those plan Bs that can at least allow them to get to stable when they were growing really fast for them and didn't get to where they wanted to go with their Series A. Revenue-based financing can make the transition into more steady growth, but not VC growth. And I posted a CB Insights article about the capital funnel. Any other questions for our lovely speakers? Jason, you talk to CPAs a lot and train them about things. Do you have a little module about training people how to do revenue-based loans for accountants?
I teach a lot of continuing professional education to CPAs, tax attorneys, and like I mentioned earlier, I can't remember who was talking about it, but she said, you know, it's hard getting accountants to look at alternatives. This is a challenge I've been facing for years in trying to get them to add the taxpayer representation service that I teach them how to do. It's an uphill battle because they don't want to expand their universe of service offerings and things like that, despite the fact that we live in a changing world. So I guess more than anything, like the presentation that you guys just did would make a perfect continuing education class for CPAs. Hint, hint, if you ever want to do that, that's what we do over at Prolera. So the thing is to always anchor it to something that they can identify. And so with something like this, when you're talking to CPAs, I would probably change the only change that I would make to the presentation would be to draw parallels to factoring, because factoring is something that they understand. It's similar enough that you can make the connections there. And if you could anchor it in terms of the pros and cons of this versus factoring, how it's the same, how it's different, just to provide context to them. I think I'm just kind of guessing here, but I think that would help CPAs to have that little light bulb moment. And then I think what would be really cool with what you guys are doing is that I think that this could be a way for you to help generate deal flow, because the business clients of CPAs, obviously those small businesses are always looking for capital. And most of them, they have one tool in their toolbox, and that's a bank loan. And a lot of those are going to be like SBA loans. A lot of them don't even know about the CDFI funds that are out there. They don't know about, we could do a friends and family angel round, raise $50,000 to bridge to some strategic goal. So that they just don't know about these options. And so one of the things that we find at Prolera, yes, our primary customer is large public accounting firms. But more and more we're getting consulting firms and things like that. Even some engineering firms that do like cost segregation studies on real estate. We get these other industry companies that they're using teaching continuing education as a marketing tool to do business development. And so if you can educate these CPAs on a source of capital that they can take to their small business, and when I say small business, I mean up to, you know, $5-10 million a year. So they're smalls, but they're big smalls. I don't know if that's an attractive market to you, or if you're looking for companies that are, you know, 20 to 100 million type range. I don't know, but for the bigger smalls, that could be a source of deal flow for you guys. That's just my kind of off the cuff thought.
Thanks, Jason. We really appreciate that. And absolutely, we would be really interested in doing continuing education. So I would love to talk with you further about that if you wouldn't mind maybe reaching out. When we first started the first fund, we spent a lot of time, at least locally, talking. We had several investor, you know, support or angel or entrepreneur support organization meetings where we invited attorneys, accountants, those types of folks to come and you know, hear about this. And unfortunately, we bought a lot of wine and beer and they never showed up. So you know, we just ended up drinking it ourselves. But we are certainly willing to talk to those kinds of groups and not just limit ourselves to the local folks. Obviously, with our next fund, we're really looking at a national base. So happy to get your thoughts on how we might approach, you know, doing that. And thanks for your thoughts on factoring or drawing it to something that they already should understand, because I agree. I think that that would help them get the concept and, you know, help us get the word out, because we absolutely do have interest in those level of companies for sure. Jason, you also had a question about funding short-term notes. So that's been an interesting discussion within our fund. Because when COVID first started, we thought maybe there would be a lot of people looking for short-term notes like that. So we did go back to our investors and say, hey, you know, would everybody be okay if we did a short-term note and recycled that capital? And everybody said yes, and then we really didn't have that opportunity. It ended up, you know, once the government got out there and started throwing money around, nobody saw the value in ours, which was fine. But we have talked about that for our second fund as well, where we would do shorter term notes in certain cases. But the idea would be that we would recycle the capital back into the fund so that, you know, we could take advantage of the longer term opportunity there. So Molly, I don't know if you have anything to add to that, but that is certainly something that we've talked about doing for sure.
Yeah, so I was gonna say, it's on our list for the second fund to do some of those.
For Jason and others who are talking about kind of how accountants see this, is this not similar to kind of when you have a royalty that you need to pay? I mean, is it a comparable way of thinking about it from an accounting standpoint?
It is, except for that I don't know that the royalty has the same principal and interest, like the principal and interest component are not as clear in a royalty, because you didn't, there isn't a set amount for that service necessarily. Royalties tend to be in perpetuity. It was originally developed in the oil and gas field. So there is like a whole industry that does revenue contracts. And so there is that to look at for this accounting. But it is not something that has been used on the investment side, and that's where it gets iffy in terms of how your investors get the income gets treated for them, is the more complicated part of the process.
Cool. Sounds like our questions are coming down to a close. Anybody have any last questions? Robert, Kyle, Shaiwal? Not hearing anything.
I'm good, thanks. Thanks for the talk. Loved it.
Thank